Fears of a global recession, escalation in the US-China trade war, and a sharp drop in bond yields have lifted gold prices sharply this year. Amidst these global growth concerns, investors are flocking towards the safer haven investments like gold. This has, however, made some analysts cautious about the crowded trade. Joining me right now to talk about the outlook of the yellow metal going forward is Joseph Cavatoni. He's the Managing Director of the World Gold Council US. Joseph, thanks very much for taking out the time. Gold demand has gone up by about 8% on a year-on-year basis in Q2 of 2019. Various factors contributing to the same. But do you feel that there is a possibility that this demand could increase further?
Absolutely. I think your comment around geopolitical risk, financial market uncertainty, and concerns overall on the investment side as to where the world will go are going to continue to be factors that drive the demand for gold. If you step back and think about the factors, there are two main categories which drive demand. One would be tactical. That includes opportunity cost, but also momentum trading, futures, derivatives, speculative positions. And if you think more completely about the drivers for gold, you'll understand that the strategic factors are what are really driving demand overall right now, whether it's economic expansion or financial market uncertainty. When investors are concerned around their ability to predict markets, gold performs extremely well in those types of environments. That's why you're seeing investors express their interest through exchange-traded funds. And you're also seeing that increase not only in the US market, but you're seeing that in Europe. And these investors are buying at record paces since 2013, particularly in the exchange-traded fund market. In terms of the central bank buying, we're actually seeing significant increases there as well. That's linked to monetary policy and the view on the dollar.
Which brings me to my next question, which is precisely that. Central banks have bought about 225 tons of gold in the second quarter of 2019. Obviously, all eyes will be out on what the Fed chief has to say with regards to his address at Jackson Hole and the forward-looking outlook with regards to the rate cuts. What happens then to the overall demand, and do you see a significant pickup thereabouts?
We continue to see that demand will stay at its pace. We think that the overall environment for economic outlook is one of uncertainty. And what we find is in those times, whether there's a rate cut of 25 basis points in the US or whether there's geopolitical risks in Europe or central bank buying for that matter, what we find is being a global asset, there are a number of factors that drive the demand for gold. So while we are definitely paying attention to what the Fed will do with rates, and there is a predicted rate cut in the near term, which over time does provide for a good environment for the gold asset class as an investment. We also look at the factors that are more globally oriented that'll also drive demand. Remember, nearly 50% of the demand for gold is consumed not only in India, but also in China. So you have to take into consideration the fact that this is a global asset. Things like the Fed rate, the Fed cut, I should say, is a factor that investors will take consideration, what the dollar will do. But then again, geopolitical risks, where the outlook is, for example, with Brexit. How will that impact the investor community more domestically in the European environment?
But just the fact that, the uncertainty and the volatility around the equity markets and the overall slowdown in a global economy is something that is a primary force that drives, people towards safer haven investments like gold. Now, those equations are not going to go away anytime soon, at least. Does that mean that you could anticipate a further uptick and a further surge in demand for gold prices? And, 25% on a one-year return for gold. We've seen that happening versus any other asset class. That seems to be a decent enough return for a one-year time frame. Do you see that moving up further and there being more extensive demand for it?
The demand level that we expect to see over time will continue to be what we consider a high level. Ultimately, investors have questions and uncertainty in their investment portfolios, so they're going to continue to analyze gold. If you think about what gold delivers in a portfolio, it delivers returns, an appropriate level of correlation, whether that's against equities or against other commodities. It also has a deep level of liquidity, and ultimately the portfolio impact is quite positive when you add it as a ballast in your portfolio. So when we think about what it can do and how it performs, we can look at examples, for example, fourth quarter of 2018, where there was an increased level of uncertainty around the financial markets worldwide and geopolitical risks, whether it was through the threat of tariffs or ongoing threat of tariffs or other activities. You would see that gold had a significant performance increase in that fourth quarter, while all other assets suffered a significant downdraft. Gold performed nearly up 9% in that fourth quarter, and ultimately bringing the asset to a relatively flat level for the year in 2018. What we're seeing again is when we have these concerns and an inability to be very comfortable or confident about asset prediction, like other assets, gold will perform well. It's done well year to date, nearly up 17%, and we continue to see the factors on the horizon, which we highlighted not only in our annual outlook, but our mid-year outlook. We reconfirmed them, that those factors are going to continue to play out over the course of the year and into 2020, and that would likely lead to an increased level of demand on the part of investors.
The other point being, from an investor standpoint, is there a slight bit of a conundrum that you are witnessing too? Because traditionally, bond holdings have provided a diversification or a hedge to stock market investments. And now that we're seeing that particular asset class is getting more expensive with yields generally fallen, do you see that will drive much of the interest towards the yellow metal?
I think that's definitely a factor that's playing in. When you have negative real rates developing in 70% of the developed markets, you're going to look for assets that can actually do what you need in your portfolio. Again, returns, that correlation benefit that comes from owning gold, ultimately having a deep level of global liquidity, you're going to find that as a component in a portfolio, it's substantial in terms of the role that it can play. And that's what we're hearing from investors when we speak to them, is understanding how their portfolio looks, what their goals and objectives are, and ultimately how gold plays a part in balancing out that objective return.
Okay, let's come down to the gold-backed ETFs now, and they too are at a 6-year high. I think 2,548 odd tons and a 67.2 ton increment in the quarter 2 of 2019. How has this moved traditionally, and how do you expect it to move?
We think that gold ETFs have become, without a question, an absolute mainstream mechanism for people to make investments in the gold market. So not only are they entrenched and well consumed in the U.S. market, where you're seeing substantial increases in the overall net new assets flowing in to the market. Overall, worldwide, we've seen about a 9% increase in net new assets for the exchange-traded fund market. That plus price appreciation has brought the total pool up to $130 billion held in exchange-traded funds. So the big surprise for us, and actually the big news on the exchange-traded fund side this year, has been the significant growth of the European market. The European ETF market is nearly at parity with the U.S. market in terms of total assets outstanding in the exchange-traded funds, with two markets being the standout, the UK and Germany. Again, investors speaking pretty definitively with their dollars, expressing an absolute comfort in owning exchange-traded funds and an actual concern around the certainty of the financial markets that they're in part of, and ultimately using gold as that ballast in their portfolio. So we see gold-backed ETFs as a mechanism for owning gold, and a mechanism that will continue to be prevalent throughout the remainder of 2019 and beyond.
Just coming on the CFTC net long positions, which have been held for some time now, which is now starting to make analysts question whether or not this could be more speculative in nature or not. What are your views on the same?
Every asset is going to have speculative flows and tactical flows, or I should say strategic flows. So while we look at the gold market, looking at the open interest in the futures market is one mechanism to understand what seems to be happening, and speculation, or what we would refer to in our drivers of the gold market momentum, definitely a factor to take into consideration. But we would encourage people to not get caught up in short-term tactical or speculative flows, and understand the more strategic dynamic that gold plays in a portfolio, and understand that the overall financial market uncertainty, or in its dual nature, economic expansion, are the things that drive gold over the long haul. If you look at long-term returns, you'll see positive results for gold, even though on the short term, tactically speaking, you may experience price moves of, up 10%, down percent over a period of time. Move away from the tactical and understand the strategic is what we would encourage investors to do.
All right, got that. Do you believe that, obviously while we've already spoken about how central banks have been loading up in terms of their gold reserves, this is probably going to be led by the emerging markets?
I think the emerging market central banks have definitely been at the forefront of de-dollarizing and actually growing the gold holdings in their portfolios. And it's a trend that we would expect to continue. Overall, again, this is about understanding the role that gold can play, not only in an investment portfolio, but also in a monetary sense. And having that ballast in a portfolio is a critical component. So central banks buying the emerging markets, definitely a de-dollarization move.
Right. Let's come down to India then, Joseph, and what's the outlook here in terms of the overall pickup in the market and the fact that India has been dialing down on its gold imports?
So what we've seen in India for the first half of the year was an early and significant growth in the jewelry demand for India. There were a number of very auspicious days, and that was actually showing signs of increased levels of demand. That actually tapered off as the price moved towards the end of second quarter. That plus the implementation of an increased tariff are clearly short-term going to have some impacts on the demand. But remember, India makes up 25% roughly of the world's gold demand. That's a significant component of what's important to understand in India. It is a mainstream asset. It is ingrained in the overall culture of the Indian market, and it's an asset of significance without fail. One of the most interesting developments that we'd like to highlight for people is the fact that just this month we released the blueprint for the India Spot Gold Exchange. What this is a working group of 27 peers plus the World Gold Council coming together to form a spot exchange in India. So it puts India on a path of developing a market, a transparent market, a much more open market for understanding price discovery, and ultimately making India potentially what it should be, which is the trading hub of significance around the globe. It could be a leading hub for trading gold in the future. And the blueprint, I would encourage people to find out more about what the blueprint is put out for a direction forward and get an understanding of what it could mean for the significance of India going forward.
Give us some takeaways with regards to this blueprint that you're talking about, Joseph, and how important is it for India?
Think strategically about gold. Don't get caught up in the tactical price moves. Right? Remember and understand that as an asset, gold has a dual nature. It'll perform well in good markets. It'll also be performing well in difficult times and uncertain times. So understand those two factors about the gold market. And ultimately, it's a question of how much to have in a portfolio or how much exposure to have to gold, not a question of whether you should or shouldn't have it. Gold's a mainstream asset, and it should be a part of an investment horizon.
All right. The other part, obviously, is the increment of the import duty on gold from 10% to 12.5%. Now, that is expected to see, have an impact on the gold demand and see a reduction of almost 2.4%, I think, in 2019 in terms of the India gold demand. Do you feel that that could probably amplify a little bit more if this becomes more permanent in nature?
The tariff is definitely going to have, the import duty is definitely going to have a significant impact on the short-term demand. I think you've highlighted some numbers that are in line with what I think we've referenced in terms of overall impact, the potential for demand, and what the impact could be. I think overall, though, this is a short-term definite impact on demand, but longer term, we would imagine that the drivers of the gold demand for the Indian market will outpace any potential impact on tariffs or for that matter, the price moves. So overall, strategically, we see the demand level for India still remaining positive.
So even in terms of the long-term Indian consumer demand, you don't expect any negative impact?
I think short term, there should definitely be some expectations of a negative impact, and I think that's already shown itself in the recent month or so in terms of what demand trends have been, that plus the price move. But overall, long term, we expect the consumer demand and the economic expansion potential for India to take a more leading role strategically in terms of driving demand.
All right. Just the last few questions. Any risks that you see going forward that could dampen this spur in gold prices?
Well, I think ultimately what people need to understand is that there will be price movements on the short term, and they just need to be understanding that, which is what you would experience with any asset class at this point. So that's probably the risk we'd highlight the most, which is make sure that you understand what are driving the tactical or the short-term speculative movements in the price, but think strategically around your overall holding of gold, because that's where ultimately the asset will perform for you in your investment portfolio.
And any long-term targets for gold?
Our position is not to put a price target on gold, but overall we see that the characteristics and the factors in the market right now continue to give us strong signals that the remainder of 2019 into 2020 are going to continue to be ideal for increased levels of demand worldwide. And remember, gold is a worldwide asset. So while there are certain factors playing out in each of the markets worldwide, whether it is a concern around geopolitical risk or, for example, concerns around Brexit, remember the demand for gold is worldwide. So that's how you need to understand strategically how it will perform over the term or long term.
Got that. Joseph, it was a pleasure chatting with you. Thank you so very much for joining us.
Thanks for having me.